joining us for today's webinar. My name is Taglo Gesese, and I'll be in the background answering any of your technical questions today. Before we begin, I'd like to give you a brief overview of your webinar console. To ask a question, go to the Q&A panel at the lower right side of the screen, type your question, select all panelists from the drop-down menu, then click Send. If you do not see the Q&A panel, go to the bottom right side of your screen, select the icon with the three dots, and then choose Q&A. We encourage you to submit questions throughout the session. To preserve confidentiality, questions will be read by our team and will not be attributed to you. We will do our very best to get to all the questions during the Q&A portion of our briefing. But if we are not able to get an answer for you today, we will follow up via email. Now, I would like to introduce our guest speakers. Ankit.
Hello, everyone.
Gabriela.
Hello.
Philip.
Hello.
Without further ado, I would like to introduce our hosts. Ludwig, the floor is yours.
Thank you. And hi, everyone. Great to have you on board. Thanks for joining. Thanks for the interest. I have assembled here a small panel from McKinsey, all experts in the space of logistics. We have Ankit, who is our corporate finance and a value creation expert, having a broad history in serving our clients in logistics. We have Philip, who is associate partner in Germany, serving ocean freight and logistics players. And lastly, Gabriela, who is leading our research in this space, and myself, partner and one of the leaders of our logistics practice. With that, let's continue and dive right in. If there is a question, you see the panel on the right lower side. As explained before, you can drop questions. We encourage you to do so. To get a lively discussion going. And with that, now to the scope and content of our webinar. As you probably have seen in the advertising of today's session, if you move to the next page, we have looked at logistics differently than in the past. We have felt that the recent crisis, with a lot of very short-term movements, and the COVID impact that has been largely also positive for logistics, has even increased the short-term focus of the players in our industry, while at the same time we believe that there are some universal truths about how to grow, to outperform and create value as a logistics player. And therefore we said, no, let's not do a short-term view again. Let's look back far in history over the last almost 20 years. So what have we done? Analyzing a big sample of ocean freight, contract logistics, freight forwarding companies, trucking, parcel, and freight rail players, and looked at their performance in terms of growth, in terms of profitability, in terms of return on invested capital, and share outperformance, and looked at that across a distinct set of time series. So between 2003 and today, we had kind of two cycles of strong growth. The first 2003 to 2007, then we had the financial crisis, and then after a slow return, 2011 to 2018-19 was again a strong growth cycle. So we wanted to really understand who has managed through those cycles to outperform the industry, disproportionate returns. And that's to discuss with you. We clustered companies in various buckets, but the most time on now are these through cycles. And I hand it over now to Ankit, who will explain in more detail what it is about. Here you go.
Thanks, Ludwig. Happy to. So essentially, we looked at a broad set of logistics companies from two lenses. One is the top line growth, and second is the economic profitability. Now, there are a particular set of companies which have outperformed on a top line growth across multiple economic cycles, and we name them as revenue outperformers. Now, there is a second type of category of companies which have outperformed on economic profitability, and we name them as profit outperformers. And of course, there is also an intersection of both of these. So essentially, companies which have outperformed both on top line growth as well as economic profitability. And that's our third category, which is profitable revenue outperformers. Now, when we looked at profitable revenue outperformers, we tried to distill it further with two additional behavioral aspects. One is uh, how many companies have actually delivered positive economic profitability out of these. So essentially, companies which have at least delivered minimum investor returns on the minimum investor returns expectations. So essentially, ROIC equal to cost of capital. That's the minimum filter. And second trait which we applied here is companies which have been resilient enough during the crisis period with higher TRS than the industry average. Now, now when we looked at these companies, these four categories, one of the interesting observation is that majority of the companies, close to 68%, have focused on profitability. 52% of the companies have focused on top line growth. And still a very large sample set of companies, close to 40%, have focused on both of these dimensions. But only 1 out of 8 companies have demonstrated the traits of through cycle outperformers. And these through cycle outperformers have been rewarded very well by market with higher TRS. If we look here, I mean, the through cycle outperformers delivered a TRS of close to 8%, which is twice the levels of industry average of 3 to 4%. So essentially, in a nutshell, these through cycle outperformers delivered twice the growth as industry average, 5% higher economic profitability than industry average, which in turn also translated into twice the returns to shareholder compared to industry average. And when we looked at the distribution of these through cycle outperformers by subsectors, we observed 3 trends. First trend is that there has not been any single subsector which is leading the pack in terms of these through cycle outperformers. So essentially, we see like a mixed distribution across subsector. Second is that at least for some of the sectors like freight forwarding, trucking, and freight rail, we observe that they have a relatively higher proportion of through cycle outperformers. And third trend is when we look at the distribution on a regional basis, we observe that most of these through cycle outperformers have majority of their business in North America. But still, when we look at the overall sample set, we still see like a huge variation in their performance, whether it is in economic profitability, growth, margin, or TRS. Now, one natural question which it raises is, what do these through cycle outperformance did differently? What common strategic themes come out of it, right, which can also help us for future value creation trajectory? And I'll request Ludwig to come again, right, and share on that.
Thank you, Ankit. Yeah, so in general, we distilled 3 themes. If we move on to the next page, 3 themes on which through the cycle outperformers focused, and that is pretty clearly visible. So first, they have grown the core in a kind of on the basis of competency, performance optimization, continuous improvement, standardization, leveraging of scale effects. And I'm going to go into a bit more detail on that. The second common theme is they have grown also inorganically. So they have built a proven M&A platform to adopt a programmatic approach to M&A. What does that mean? It's kind of not opportunistically do one deal when it kind of there's an opportunity, but rather constantly scanning the market and having view on which areas geographically or in adjacent fields are the ones where we need to use inorganic growth to scale. And then thirdly, and that's probably the most interesting outcome of our research, and we'll see a bit more on that, they had an anticipation of economic cycles in their investments. So while most of the companies, and we all know that we have high capex spend in many of our logistics segments, most of the companies spend a lot on capex. But when do they spend it? The through cycle outperformers reduce spending in the early time phases of a downturn drastically. But then, as soon as the first glimpse of hope and the end of, light at the end of the tunnel is visible, they already spend on capex quite a bit again. So they outspend their peers at times where up again, and the non-outperforming different pattern. You'll get to see it in a minute. But let's spend a bit time on each of the three themes, because we believe they insightful for you online, and we have a few case examples with us today. We move to the next page, please. So what does kind of growing the core through kind of focus on core competencies and performance optimization mean actually? So first, we have seen companies that really kind of innovate and extend their competitive advantage in their core business by focusing on economies of scale and building a kind of high quality, high service level network. And we see that especially in the forwarding companies, also in the trucking companies, but actually across all, and most logistics businesses are network businesses. So really a strong focus on improving the existing core and improving the competitive edge. Secondly, a ruthless performance management aspect. That is a benchmarking culture on both the commercial and the operational side, to never let the efficiency slip, to continuously monitor, to continuously improve the standards and roll the standards out and ensure it is adhered to standards. And again, some forwarder and distributor company examples here. Then thirdly, right now we are all talking about technology and digital, but even in 2003, the through cycle outperformers already started to disproportionately invest into a technology platform and backbone to automate and standardize their processes. And then some companies also within their core shifted to more profitable elements of that core. I get to it in a minute. If we now move on, we have a couple of specific case studies here. And one is Kühne and Nagel. You all know the company. So they were probably the first to adopt a ruthless standardization across the globe in the air and ocean forwarding business, which when they started used to be a very customized, a very people-driven business. They replaced a lot of that by a strong IT focus and standardization focus that also allowed them to be better performance managers. And then obviously within their core, they also focused on the high margin verticals where more value added services could be sold. And that is one case example. If we go to the next, we have J.B. Hunt in the US, an example for within kind of the core the kind of large road freight space, which is the largest segment of logistics across the world, they have early on discovered in the very fragmented plain vanilla FTL space, they can't earn their cost of capital and outperform. Therefore, they went more into a intermodal, dedicated contract services space, and a solution space. And that already in the 1990s, which by now it gives them a very, very large customer base, for instance, in the intermodal ocean freight. So almost 25 to 30% market share in the kind of processing of ocean container imports into on the land side in the US. And that is another quite striking example, rewarded with a high value creation. And one more example I want to talk about on the next page is Main Freight. It's a smaller company, maybe not known to everyone that well, but what's interesting about them is their origin is New Zealand, a market that is not known to be home to any outperformer in any industry because it's just such a small market. But they have understood to replicate their winning platform of running trucking networks efficiently, first and through M&A, first from New Zealand to Australia, then from Australia to other markets in Asia, from there also through an acquisition into the United States, and then finally into Europe. And therefore, kind of with all of their kind of investments to their platform and processes, have now a much larger scale to distribute any investment across. And that was probably the only chance a company from that small market had to become a global outperformer. With that, I'm handing it back to Gabriela. Talk us more through M&A.
Yes, thank you, Ludwig. So let me tell a bit more about our analysis of the M&A approach of our through-cycle outperformers group. So we have looked into their activities in the M&A during the crisis, and we have come to a couple of quite interesting observations. So first of all, our through-cycle outperformers group have been using much more the M&A strategy than the other companies. So we see that almost 70% more users among our outperformers group. When we have looked at the deals that this group was making during the crisis, we found out that we had 3.5 more deals, 3.5 times more deals among the through-cycle outperformers. However, what is interesting is that the average deal value was around 10% lower than the deals made by the other players. And those two factors pretty much fulfill the definition of the programmatic approach that Ludwig mentioned earlier. So we see that we have more deals, but the average deal size is lower than the industry. So there is this constant strategy rather than really just chasing larger one-off opportunity. When it comes to the focus of the deals, we see that the through-cycle outperformers have been slightly more interested in the moving into adjacent industry, so a little over 20% more deals in adjacent sectors, and over like 1/3 of more focus on the deals outside of the geographic home market, so expanding into other regions. So also trying to pursue new opportunities in other geographies. If we move to the next page, I will tell a bit more about how our Outperformers group has performed in the CapEx strategy. So here we have also an interesting observation when we compare the overall CapEx spend through cycle Outperformers versus other companies. We have, quite a striking observation. So our Outperformers were much faster responding to the economic situation, and during the time of the downturn, they were able to slow down their CapEx to kind of reflect the situation on the market. However, they were also faster in observing the recovery and coming back to the normal. So they were able to switch back to the CapEx expenditure track much faster, whereas the remaining group of companies maintain pretty stable approach to the CapEx spend. When we move to the next slide. Yeah, those observations and like overall performance of our through cycle group and the view of the historical resilience is also just driving to a question. So if this historical resilience is reflected in the current performance, in the current situation, in the current COVID-19 crisis. And in order to answer that, we have looked into the TRS results in 2020 to see and compare how our through cycle Outperformers is doing right now. And the result is also quite interesting. So, well, we see that within this group, we have like 1% of the total return to shareholders, which might not be a great result. However, when we compare to the other companies that resulted in the negative TRS, we see that they are doing much better than the overall industry. So the historical performance has been, in this case, really a good indicator of current reaction to the crisis. And let me pass back to Ludwig, who will tell a bit more about the current COVID-19 situation and the ways to address it.
Yeah, thank you, Gabriela. Yeah, it's awesome to see. I mean, when we look at this page 19, we didn't analyze the Outperformers of 2020 and compare them with the rest. No, we looked at those companies that have managed through cycle from 2003 onwards till the end of 2018 to be through cycle Outperformers. And it was actually then no surprise that also in 2020, especially in the first half of the year when the crisis hit, they outperformed their peers again on shareholder return and many other metrics, by the way. Now, what does that mean for you all managing logistics companies today and going forward? If we move on the next page, we have basically our ladder of how to successfully exit COVID-19 crisis. And I mean, obviously, most of your companies don't feel like in a crisis, at least not from a demand standpoint, because there is high logistics demand. But still, there is a lot of change happening in the industry. And while out of this 5-step framework, resolving the immediate challenges and creating resiliency to stand through the immediate shock that probably most of you have successfully managed. Now the focus is really on the next 3 steps. How can we create a detailed plan, and what are the ingredients of a detailed plan to return to a pre-COVID scale or even a higher scale quickly from point of today, and how can we reimagine the own operating model and also the services to the customers in the next normal. I think those two are really should be focused in executive teams at logistics companies these days. And if I would think about some of the ingredients, then it's pretty clear that one is around CapEx. If we see and know that through cycle outperformers have typically accelerated in the middle of the curve or in the middle of the bend, then you just need to find for yourself, are you at that point already, or observe very carefully when that point is arrived, then to really open up the investment to be ahead of the rest of the group. And then other areas are, again, the M&A topic. How can I, at least if I haven't been a programmatic M&A company in the past, how can I start to be that going forward? That doesn't mean you have to focus on any kind of companies that need to do fire sales right now, but rather to prepare a plan to have this programmatic view on M&A. And I mean, the basics are still the basics. Also, those need to get right around operational and commercial excellence. And when I talk about reimagination, then a few elements for logistics come to mind. One is definitely the sustainability. How can I grow with a more kind of carbon neutral or even reduce my carbon footprint? How can I attract customers by new products that are more economically friendly? Because that will be a competitive edge in the future. And there are obviously some others we can talk in our Q&A in a bit. And with that, obviously, I expect you all have questions and comments. I would still say let's finish with an additional block of our webinar here, where I will hand over to Philip, that is around how do we as McKinsey see the next few years or next few months from a demand standpoint and an outlook standpoint, so that you at least know what our baseline for logistics outperformance going forward is. And then we get back to questions. Philip, over to you.
Great, many thanks. And I think given that we've had some extensive analyses of how companies have performed in the past, it will be also interesting to look back over this very different year of 2020 and what also happened in the logistics markets, but also think through what the indicators and what the macroeconomic logics could be until we see actually that the supply-demand balance could restore. If we look onto the next page, I think you probably all are familiar that the supply and demand in the logistics market are out of balance at this stage. And we've quite heavily seen, particularly in the last quarter of 2020, that there was a significant change. From our perspective, there are 4 items that I want to mention. On the demand side, we see that there was a significant shift from services consumption to goods consumption, which pushed up demand by 10%. We see on the capacity side or the supply side, however, that ocean freight capacity was almost stable and air cargo capacity was significantly reduced because of the lack of belly capacity. As you all know, the planes from the passenger sides are down to historically low levels. And this in turn has led to significant utilization and then of course significant rate levels both in ocean, air, but also in the other logistics sectors. And I think the key question for all of us is now, when will we expect a trend reversal? What are the indicators that we can look at to come up with an outlook? I try to give you a bit of an overview of the status quo, what we see, a bit of a focus on the United States in the following pages, and then also share as of now an outlook, how the situation could pan out. But I mean, as we all know, this situation is something that we have never experienced before. And obviously, all the projections can change depending on the situation out there. Great. If we move to the next page, just a brief look into demand. And historically, for the past 60 years, we've actually seen a gradual but steady shift away from consumption for goods towards a consumption in services, from 55% down to 31%. But now in 2020, the first time we've had really a significant shift back. And this shift was worth more than $500 billion on an annual basis. So that's quite a significant shift, which probably not many in the market had anticipated in the beginning of last year when we were seeing lockdowns. We saw that capacity was taken out of the shipping market. We've seen the challenges in the air cargo market, but that situation has now materialized, and we still observe that demand for goods is pretty high in the markets. On the inventory side, which we come on the next page to, this situation is confirmed, and we see quite a difference to the financial crisis in 2008, 2009, which of course was a completely different event because there was an economic event only, not a humanitarian crisis as we are experiencing right now. But in terms of the inventory sales ratios, we see that there was a very short spike in this ratio, indicating that the inventories were full. But we see, particularly on the retail side, that the inventories are still at a historical low, which means we expect that at some stage those inventories will have to catch up again. If we take that now into the capacity view on the following page, then we see that global ocean capacity has been of course, growing in the past decade, but the rate of growth has significantly reduced. And even though all the vessels are apparently out there on the market and on the oceans and not laid up, we haven't seen such big capacity growth that would be able to accommodate the significant roughly 10% increase in demand. And that's why we've seen those exorbitant rates, particularly on the Far East and the Trans-Pacific routes, where we see an increase of up to 89%, for example, on the Trans-Pacific throughout 2019 to 2020, which is quite significant, of course. On the air cargo side, I think given the significant reduction in capacity, that is a very similar effect. But of course, the effect on the yields is even stronger, just driven by the supply challenges. Moving on to sort of the conclusion that we have on the following page. In the end, we think there are three key effects that we now need to look out to see how a potential supply-demand balance restoration could look like. First of all, it's the GDP growth. And we've actually seen that the world GDP is more tracking towards something that indicates a return to pre-COVID-19 levels by Q3 2021. But this, of course, highly depends on how the situation evolves in the next coming months. The second point is goods versus services spending. So when will this trend actually reverse that we had seen now in 2020? And we believe this is mainly driven by vaccination. And there the estimates range from a critical mass that could be achieved in Q3, Q4 2021. Of course, the summer season can help. And we believe it makes a lot of sense to also leverage travel information as early indicators. For example, looking into travel searches, travel bookings could give us, once some of the lockdowns are lifted, once some of the people are looking to travel again, an indication that the goods spending might actually decrease and people might use the money that they also saved up to spend on more services again. The third factor to keep in mind is that the inventories are relatively low, which means even if we see a trend reversal on the first 2 points, it would still take 1 or 2 months to actually fill up inventories back to pre-crisis levels, so that we would then achieve a more balanced supply-demand situation in global freight markets. To sum it up, the current thinking that we have is that as of now, ocean shipping supply-demand balance could be restored as early as Q2, Q3 in this year, taking all those factors into account, and of course, looking how the situation develops. Air cargo is a market where we believe that this will take longer time, particularly still due to the ongoing supply shortage, and road cargo could exhibit a similar situation or similar timeline than ocean shipping. So this was a short excursus in our thinking on the more macro development. I hope this is insightful, and of course also happy to take questions.
Thank you, Philip. Excellent. Why don't we then move on to questions on all aspects of the webinar so far? Gabriela, Ankit, maybe you can keep an eye on all the questions that have already come in, and we will process one by one.
Sure. So we have a question around the elasticity between the deal amount and the deal value. So what limits the non-outperformers to adopt the same strategy as the through cycle outperformers?
I'm happy to try answering that one, and Ankit, please chip in here. I'm not 100% kind of sure, but how I interpret the question is why kind of have the non-outperformers have gone down the route of rather few large-scale deals and not this programmatic smaller deal strategy. I think one reason is and was that in order to do a more programmatic string of pearls approach, you need to have a much more kind of planned procedure of knowing in which segments, in which geographies, and then diving deep into scanning the market also for mid-sized companies that are interesting. While if you only reactively think about M&A, then you think about kind of big competitors failing or divesting and then jump on the opportunity. But Ankit, probably you have a bit more insight even.
Yeah, happy to share. I mean, based on our empirical research, we believe that companies which pursue programmatic M&A as part of their strategy generally deliver better returns because of several reasons, right? One is they get like more and more experience as they do like large number of deals, and B, they also kind of embed this M&A as a part of their holistic strategy, which helps them to understand what are the adjacencies they can target, what are the motivation levels for M&A. Now, talking about the question specifically, what limits non-outperformers to adopt the same strategy, there could be several reasons to that. One of the reasons could be just whether M&A is an active part of your strategy or not. Second reason could be could also be the timing thing. When any of these companies decided to pursue M&A as a part of their strategy, whether there are opportunities available in the market or not, whether the timing is right or not, how focusedly we are pursuing these opportunities, and whether there are any opportunities available at that time.
Okay, thank you, Ankit and Ludwig. We have another question. So with the digitalization in B2B and B2C, do you see a shift from FTL to LTL? And what can be the impact for the outperformers?
Yeah, let me again start, and maybe Philip, you can this time pitch in. So in general, the digital effects are I have better visibility of supply and demand, and through my data and forecasting and machine learning, etc., I can more accurately steer my supply chain as a shipper, which means that I kind of probably can better make use of less than container load in ocean freight, less than truck load in road freight offers, whenever I know I'm not having enough load to fill a full truck. And therefore, we have seen already in the last years an outgrowth of both LTL to FTL and LCL to FCL. And through digital, we only see that continuing. And then two more drivers will improve kind of the less than product category. One is sustainability. When I have to factor in carbon cost or cost to the environment, then shipping half empty containers or trucks is even more costly than consolidating less than shipments. And then one more is, if the rates in ocean and road freight are so high as they are right now, I'm again incentivized to optimize and consolidate wherever possible. And that's also benefiting these networks. So we see kind of a lot of drivers why these shifts will happen and continue to happen. And the impact to Outperformers is probably they will benefit, because Outperformers were the ones jumping earlier than others on these more specialized products. Philip, anything to add?
Yeah, I mean, I fully agree. I think the other point here is, of course, also that the digitalization that we see is also driving towards a stronger role of platforms that match supply and demand. And it also offers a unique opportunity to make the pricing better. Today, some of the pricing for the less than container or less than truckload is relatively complex, and with a higher degree of digital and analytics usage, also this pricing can be made much quicker and easier, thereby allowing this mode to probably gain more importance.
Thank you, Philip and Ludwig. So like we have a bit linked question about the impact and the response to the new platform, freight platform like Quick Cargo, Uber Freight, Convoy, and Sender. So can you maybe add thoughts on that?
So our view in general on platforms is, yes, they improve efficiency of freight and logistics markets because they kind of optimize supply and demand and quickly bring that kind of unknown supply to unknown demand to the fragmented supply. So it works very well on the trucking side. It works less well whenever the supply side, i.e. the carriers, are in a more consolidated state. So in ocean freight, where the top 10 container lines control the market, there's much less platform play to be expected than in road freight. Obviously, kind of linked to platforms, there's also the phenomenon of very digital freight forwarders that are not only a matching platform, matching supply and demand, but actually forwarders that take responsibility for the shipment end to end, but do that in a much more automated and digital way, leveraging kind of the data transparency that's out there in the market. Therefore, we do see a play for them. We have also last year published our first report on startup funding and logistics, which really confirms that a lot of potential is seen there by investors. But let's also not forget that most logistics is network businesses and supply chains that have been optimized over years. And so we don't only have spot business that might find a bit more efficient way through a digital platform. we do have large contractual relationships where logistics companies optimize their network for one or a couple of large customers. We do think that will stay, and that will, to a certain extent, also protect the incumbents. But for spot business and for efficiency reasons, also in your own distribution, as a legacy company, you should not miss the boat. And Philip, I know you have also done some research on digital channels for the incumbents. Not sure if you want to add anything on that. Otherwise, we can move to the next question.
Okay, I think we can move to the next one then. So we have a question on the M&A strategy. So can we say that the active M&A during the crisis is the consequence of the conservative CapEx policy during the crisis time?
Happy to take that, Gabriela. The short answer is yes, it could be. However, there could be some other motivations for this M&A strategy during the crisis period as well. Some of the other motivation could be like during the crisis, the balance sheet of some of the players was in distressed position, and M&A was becoming like a natural theme at that time for those players. And one of the other reason could also be the valuation level itself, right? There were opportunities available in the market at attractive valuation levels, which at least some of the big players with strong balance sheet have leveraged during that period.
Okay, and then there is one more also related to the CapEx policy. So like how singular is the conclusion? So the graph comes across as where outperformers would have a linear upwards trend over the time, and the others jumped in 2007, so like increased the spend and then plateaued since then.
Yeah, let me take that briefly. Obviously, yes, that's how you can read the line. But what's behind the line from our point of view is the non-outperformers being not fast and agile enough to cut back spending, CapEx spending, in the 2008 and 9 years of crisis, which hurt them quite badly. So they, from a profitability and cash flow level, have not recovered quickly after the crisis and didn't have money and cash to spend on CapEx unless 2-3 years until 2-3 years later, when they have made some operating cash flow again, while the outperformers kind of cut tight and protected some of their funds to spend them when it would really matter. That's at least what we have seen, and then protected a continuous CapEx spend, which is also logical because after the financial crisis, the economic development was quite linear growth. It will be interesting, however, to see how in 2 years' time we look back at the CapEx spending throughout COVID crisis and afterwards.
Okay, thank you, Ludwig. And we also have a question about this forward-looking perspective. So will the warehousing and hubs would become more important for the future LSPs, or that would be like, if it's possible, to focus on just on the transport and collaboration with the local partners rather than the hubs and warehousing network?
I think we can keep that one quick. There's no one true answer. It depends on the customer vertical you serve. We see right now, even in the pharmaceutical logistics around vaccine delivery and storage, that in the kind of very distinct verticals of pharma, life sciences, also of e-commerce and some others that are non-commodity, so to say, an integration of and control of both storage and warehousing processes as well as transportation processes, and being able to promise consistent service levels across the entire supply chain is super important. Therefore, in those verticals, I wouldn't follow this logic of you can focus on transport only. In more commodity type goods, you probably can.
Okay, thanks. Another one, what might be the impact of climate change, like becoming CO2 neutral, for example, and circular on the outperformers? Is investment in the new technology a challenge for financing the change? And also we have another that is pretty much related also to the carbon neutral, and is specifically targeted into freight railroads. So like how they can reflect this focus on the carbon neutral, and while they are still very much dependent on the transporting of coal. So
I'm happy to take the later one. So traditionally, I mean, the way that investors look at any company, they value the future expected cash flows. So for a business like Freight Railroad, which is engaged in transporting coal, and if investors believe that the expected growth will be on the lower side, that will be kind of reflected in their valuation levels. And one of the other things which institutional investors have started to give a lot of emphasis on is whether the company is kind of creating value for all the ecosystem, for entire ecosystem or not, whether they have social angle linked to their business levels or not. So something at least which investors have started to pay attention towards. But again, right, from a company standpoint, important to identify which businesses are your core, which businesses will give us enough growth to excel in future, and convince investors about that.
Yeah, that's a super important point, Ankit. So right now it might be the highest margin business, but investors will look through that and say, this is declining in volume and getting more challenged on margin, given the public and political pressure. And therefore, kind of the net present value of this kind of right now still high earning segment isn't that high, and other segments that are growing and will have a better future outlook are much more appreciated by investors. Therefore, their push would be take the margins from what you get today and reinvest it into something that kind of can help you sustain while in a greener world, so to say.
okay, thank you. So like this would you have any additional thoughts about like the general impact of the climate change? Like,
well, one thing we mentioned already, which is kind of be very efficient on packaging and not shipping around air in containers. Therefore, kind of more consolidation, smaller kind of shipment sizes. The scale advantage of the biggest container ships or trucks or aircraft has actually already been exploited. So there's not much in the near term on the basically more efficient asset side. In the mid to long term, obviously there's electrification, hydrogen, and alternative fuels that should be a very important part of any strategy for logistics companies. And that's actually true if you operate these assets or if you are an asset-light company subcontracting them, because the ESG goals will hit you for own and subcontracted emissions. So that's kind of our perspective, but we also need to be honest that logistics, so physical flows across the world, that will continue to be there. they cannot be decarbonized immediately. It's a long-term game that will require investments.
Okay, thanks a lot. So, like, would we have still a bit of time for another question?
Maybe one or two more questions, and then
Okay.
we'll close.
So maybe last one. Do you expect the autonomous platooning for tracking to be a game changer in EU or US?
Game changer is a difficult word. And my current hypothesis would be no. From all that we have heard and seen, it can contribute to a 10 to 20% emission reduction and fuel consumption reduction. But the infrastructure needs, the safety concerns, the organizational complexity of realizing it, renders it more a bridge technology for the heavy duty trucks on long haul road freight for the years until we have either battery electric or hydrogen or alternative fuels. That would be my current guess.
Okay, thanks, Ludwig.
Maybe one last question before we call it a day.
So so like, what would be the main still challenge related to the COVID vaccine logistics?
Yeah, that's my pet topic. I was involved on several fronts, trying to find solution to this. Definitely one of the biggest logistical challenges in the past centuries. The good thing is we are getting used to cold chain at minus 70 degrees through the right packaging, dry ice, etc. That is kind of manageable. The good thing also is the vaccine is a very dense cargo. So within kind of a pallet of vaccines can serve almost 1 million people or 500,000 people. So that's really helping as well. And then I do believe that there is so much attention, investment, and solution design going on right now with the largest and most professional logistics companies in the world, that it's not going to be the logistics that fails. It's not going to be any type of transport or storage. It's rather the bottleneck in production and the vaccination process itself that might be a bottleneck. But it will be a core focus and a huge role for the logistics industry as a whole. Even though the volume might be small, but the value and the importance and the urgency is high like little else.
Okay.
I think with that, that might be a nice word. Let's all hope that the vaccination runs smoothly, that we will return to a kind of a bit more normalcy soon. And I hope we hear you all again in the next webinar on logistics.